A $6,000 client payment lands in your account. For a few days, you feel rich. Then rent clears, quarterly taxes are due, an annual software subscription renews, and your laptop starts making a sound that definitely sounds expensive. Suddenly, that $6,000 feels like it was never really yours. The problem is not simply unpredictable income. It is that one bank balance is trying to fund your present, your taxes, your slow months, and your future, all at once. And there is one mistake that makes even an organized sinking fund system fail. When you miss a contribution, you pretend the money and the deadline disappeared. They did not. Later, I will show you the exact recalculation that keeps the plan on track. But first, let us give that $6,000 four clear jobs. The system has four buckets: tax reserve, essential income buffer, predictable future expenses, and emergency fund. By the end of this video, you will know where each payment should go before you spend it, even if you are starting from zero. Meet Solo Sam. Sam is a freelance designer who has just received that $6,000 payment. His current tax estimate tells him to reserve 25%, so $500 moves to his tax reserve. He protects $2,000 for essential personal and business costs until his next expected payment. He puts $600 into his income buffer. Then he contributes $400 toward an insurance renewal, $200 toward annual software, $200 toward equipment replacement, and $300 toward his emergency fund. That leaves $800. Here is the complete allocation. Tax reserve, $500. Immediate essentials, $2,000. Income buffer, $600. Predictable expenses, $800. Emergency fund, $300. Remaining, $800. This is an example, not a universal allocation. The percentages and priorities must fit your own situation. Now let us examine the four buckets Sam used. Bucket 1, tax reserve. Its purpose is to protect money that may be owed in taxes. What goes in? Money for applicable income, self-employment, state, local, or other business-related taxes. What does not go in? Operating expenses or personal spending. In this example, Sam moves his estimated 25%, $500, immediately after receiving the payment. Your tax percentage depends on your country and region, income level, tax bracket, business structure, deductible expenses, filing status, other household income, credits, and estimated payment obligations. Use this as a planning framework, not as personalized tax advice. For U.S. viewers, self-employment tax is generally 15.3% of the applicable portion of net self-employment earnings, not simply 15.3% of every dollar a client pays you. Your total bill may also include federal, state, and local income taxes. Use the current IRS Form 1040-ES or consult a qualified tax professional for an estimate based on your circumstances. The 25% in Sam's example is not a universal rule. Bucket 2, essential income buffer. Its purpose is to cover necessities during a slow month or client gap. What goes in? Housing, groceries, insurance, utilities, minimum debt payments, and critical business costs required to keep earning. What does not go in? Optional upgrades, entertainment, investing, or extra debt payments. In this example, Sam adds $600 so that a late client payment does not immediately become a crisis. Minimum debt payments belong with essential obligations. Extra debt payments are a separate goal funded after taxes and core stability are protected. High-interest debt may deserve greater priority depending on its cost and urgency, but it does not require a fifth bucket. Bucket 3, predictable future expenses. Its purpose is to prepare for expenses you know or can reasonably expect are coming. What goes in? Annual insurance, software renewals, professional fees, vehicle expenses, planned work travel, and equipment replacement. What does not go in? Sudden events you could not reasonably predict. In this example, Sam directs $400 to insurance, $200 to software, and $200 to equipment replacement. These can be separate sub-buckets, but they all remain inside predictable future expenses. For each expense, record the target, the amount already saved, and the deadline. Then calculate the target amount minus what you have already saved, divided by the number of funding periods remaining. If a $200 software renewal is due in 12 months and you have nothing saved, divide $200 by 12. The required contribution is $100 per month. If you are paid irregularly, divide the remaining target by the number of client payments you realistically expect before the deadline. Bucket 4, Emergency Fund. Its purpose is to protect you from major expenses you could not reasonably plan for. What goes in? A serious medical issue, an urgent family situation, or another genuine financial shock. What does not go in? An annual renewal, routine maintenance, or a laptop you already knew needed replacing? In this example, Sam contributes $300 to strengthen his protection against genuinely unexpected events. If predictable bills repeatedly drain your emergency savings, you do not have an emergency fund problem. You have a planning problem. Now let us apply the week payment test. Sam's $6,000 payment was the easy test. But what happens when his next payment is only $900? At his example rate of 25%, $225 goes to the tax reserve. That leaves $675, which cannot fully fund every target. So Sam follows an order he decided before the money arrived. First, taxes. Second, immediate essentials and minimum debt payments. Third, legal or contractual obligations, such as required business insurance, professional fees, loan or lease payments, and software contracts that cannot yet be canceled. Fourth, the income buffer. Fifth, predictable expenses ordered by deadline. Then come flexible goals, investing, extra debt payments, and extra spending. Sam protects the most urgent items and pauses his flexible equipment contribution, but the missing contribution does not disappear. This is the mistake that quietly breaks the system. Sam's equipment target is $1,200. After 6 months, he should have saved $600. But because he skipped one $100 contribution, he has only $500. Here is the new calculation. Original target, $1,200. Saved, $500. Remaining $700. Months left, 6. New monthly contribution, $116.67. The original plan was $100 per month. It must now become approximately $116.67 per month to reach the same target on time. Without recalculating, Sam may still look organized, but he will quietly fall behind. Sam now has 3 honest choices. He can increase his future contributions, he can extend the deadline, or he can reduce the target. If he does none of them, the bucket may look organized while the plan quietly fails. Every payment, therefore, requires 2 actions. First, allocate the money, then recalculate any target you could not fund. Here is how to start today. If you already have available savings, do not divide them equally just to make every bucket look active. Protect known taxes and immediate essentials first, followed by the closest hard deadlines. If you are starting from zero, do not wait for one giant payment. Begin with taxes and essentials, then build the other buckets gradually. Use this 5-step checklist. First, check the last 12 months of your bank and credit card statements for non-monthly expenses. Second, give every predictable expense a target and deadline. Third, calculate the required contribution. Fourth, create separate accounts, vaults, or labels. You do not need 4 different banks. Fifth, choose a regular review date to update your balances, deadlines, income estimates, and missed contributions. If your targets require more money than you have available, the system has exposed the gap early enough for you to act. You can reduce a target, cancel a service, move a flexible deadline, choose a cheaper option, or increase your revenue goal. A sinking fund can organize limited income. It cannot manufacture money. Before this system, one balance creates constant uncertainty. Every payment looks available until your obligations catch up. After this system, taxes are protected, future expenses show visible progress, slow months become manageable, and genuine emergencies stop destroying every other goal. The goal is not to feel rich for 7 days after a client pays you. The goal is to open your banking app and actually know what the balance means. If you want more practical systems for unpredictable income, subscribe to the Irregular Income Playbook. And if you want to build the next part of this system, watch the video on screen. I will see you in the next one.